Kaenan, how are you doing, my friend? How's your day going?
Day's going fantastic. It's a beautiful day. Thanks for the time. It's nice outside, so I'm looking forward to talking with you and then getting outside to play a little bit.
Thank you very much for joining me today. So today I have Kaenan Hertz from InsurTech Advisors. He's the managing partner, and we're going to talk about Root. And it's hard for me to say that other meme stock, but the thing is that Root and Clover are on the Reddit sort of a short squeeze list. So somehow two insurance companies got on that AMC, GameStop, although we haven't seen much on that, let's call it volatility on the Root side. But let's start, with the big numbers that what we've seen, and that's a great, starting point. Root IPO'd, the max was at the day of the IPO, $27. Today, they are at $10.71. What happened there? Now, before we even start talking about that, we need to give the disclaimer, of course, that we are not financial advisors. Everything that you're going to hear today is entertainment, not trying to solicit any investment or anything like that, right? We are safe. Good? Okay.
Sounds like a plan.
Yeah. So, Kaenan, and this is where I need to look, go and look into my notes because we have so many different topics to talk about. So what do you think going on? Let's talk about Clover and their volatility. What do you reckon is going on there?
Well, at the end of the day, Clover got picked up by the meme stocks. Clover had, interestingly enough, maybe only a 10% short sell squeeze, but they were so low in dollar value that people picked it up, and it bumped up. I think the top probably around $25+, but as you know, they crashed also. And that's part of the problem with the meme stocks is, yes, you can look at an AMC and you can look at a GameStop, and for the most part, it's a trajectory up. But even with GameStop, it's been up and crashed, almost like a Bitcoin pricing of late. And so, at a lower price amount, it's easier for individual investors to play. Both Clover and, more importantly, Root really don't have a large amount of their stock in float. And what does that mean? It means the number of shares that you could actually buy. For Root, for instance, probably 95 to 98% of their shares are owned by 25 organizations or individuals. And so if you think about it, the share price fluctuation, it's really only the smaller institutional investors who own X or Y, because these larger institutional investors aren't trading. So that also contributes to the fact that there might be volatility and the likes, and also will contribute to the fact that it went down. A question for you is on that, when I just said that probably 95+% is owned by 25 individuals and organizations.
Yeah.
Who do you think the top individual or organization is that owns shares, and what percent do you think they own of Root?
So funny enough, I was looking at Yahoo Finance earlier to see who has the holding. So I don't want to give a spoiler to anyone because I completely black out on that answer. Although I looked at that and tried to figure out, before our conversation today, I was trying to figure out how many shares they have and understand the cap size. And frankly, I didn't manage to calculate it because I was looking at their assets, and their the shareholders. So that will be, when we're looking at assets and of course liability plus shareholders, it was at 1.7 billion. And I tried to revert that, the simple calculation that we all learn in business school, which is that, just divide it by the price. And it still couldn't really figure out how many shares they have. And I feel a little bit embarrassed by that.
Well, let me tell you. So you'd think it would be one of the founders. Fair enough?
Fair enough.
Like Alex Trim or Dan Manges, right? One of the co-founders. But in fact, the two of them right now only own about 15% of the company. A person by the name of Chris Olsen owns 20%.
And who's Chris Olsen?
Thank you for asking. Chris Olsen Chris Olson runs a VC out of Columbus, Ohio, which is where Root's headquartered, called Drive Capital. But interestingly, Drive Capital themselves only own about 1% of Root. So he himself has a lot of his own money parked here in Root, which I found pretty interesting. He owns over 20% of the company right now. So when you sort of like look at that, right? So between him and the top two, you're at 35% of the company, right? So there isn't that much play for people to be buying and selling stocks when, you know, the founders and one of the largest investors sort of have a large block. And if they were to try to move a large block of shares, it would probably so detrimentally, you know, price the company. So I thought that was pretty interesting.
It's interesting because this is something that you mentioned crypto earlier, and there is a nice correlation there in terms of what we call whale watching, because you need to follow the people, the whales, which you assume they are whales, right, because of their wallet, and you don't really know who they are, what they are, but you really want to understand because they can influence the price by, you know, introducing, selling, or transferring different blocks of crypto, or in this case, in Olson's case, well, he's a majority shareholder. Yep.
No, by far. He's also on the board by virtue of that, which you wouldn't be, which is not, which would be as expected. But, you know, you had brought up essentially trying to figure out their capital and all of this. You know, at the end of 2020, right? So like 6 months ago, you know, they had a market cap of about just under $4 billion, right? That's still significantly below where they launched. But, you know, at the end of March, so the end of their first quarter, that had dropped down to about $3.5 billion. Right? So a pretty sizable drop. But more importantly, when you look at the enterprise value, right? So backing out goodwill and all of these things, it went down from 3.9 billion to 2.6. So that's about a 50% drop in enterprise value over 3 months.
So how do you even great? How do you explain it? Is there a way to explain it?
Yeah, at the end of it, I don't know if there's a beautiful, simple way to explain it, but it's certainly driven by the fact that the stock price is cratered. It's also driven by the fact that there are, you know, short sellers, and it's driven by the fact that goodwill has eroded, right? And so, you know, while on the plus side, they've seen net premiums written grow. I mean, at the end of for the fourth quarter of 2020, which was, you know, at the tail end of the COVID crisis, they were writing $146 million in premium. You know, at the end of first quarter, that was up to 202. Right? That's a pretty nice jump. So in that regard, they're doing things right. Their losses, their gross loss or net loss went down from 133 million to 100 million, but they're still losing 100 million a quarter. And that kind of then feeds into this enterprise value, right?
For the people who are more detail-oriented, it was 99.6 million. But, you know, 400,000 between friends, what is that?
A lot of coffee or a lot of espressos there.
Oh, yes, indeed. Well, actually, it's the weekend. So that's what we call black coffee or Turkish coffee. Really depends how you broil that coffee.
With cardamom or without? Just getting us off the track.
With cardamom. I know, with cardamom. Yeah. That's my humble weekend treat. Going back to Root. So they're on the right direction, right? The numbers are talking about growth, and this is where we need to differentiate between, okay, it's a SaaS company or whatever type of a company versus an insurance company. Because when we read the Q1 2021 report, you see that there is a nice trajectory, especially when you compare it to Q1 2020, Q1 2019, and they are on their path. They are actually in the green. They had profit, 6 million.
Mm-hmm.
So where are they going and what are we missing there? Yeah. Because we are still, again, the stock now is at 10.71.
Listen, I think in the end, the one other metric that's going in the right direction is their price per policy, right? Premium per policy. At the first quarter 2019, it was 770. They ended the third quarter 2021, the first quarter 2021 at 958, right? So pretty much they're gaining a couple of percentage points per quarter in premium. That's fantastic, right? But that's also tied to the fact that they're repricing. And, when you listen to what they're saying publicly through their annual report or through press releases, a lot of that is driven by becoming more accurate in their pricing and their modeling. And consequently, that's going great. What's challenging for them is acquiring customers at a reasonable price, right? So if you look at customer acquisition costs, so the traditional way of calculating a customer acquisition cost is look at how many customers they had at the beginning of the period and at the end of the period, and look at how much money they spent on marketing and sales, and divide the two, and that's what you get. When you do that, for the most part, this past quarter, first quarter 2021, you were at $1,800 per customer, right? If you remember, they're at a $900 premium, right?
Yep.
So there's, it's going to take them
2 years,
many years to recover the marketing costs, and that's what makes them not profitable. Forget other operational expenses. They do seem to be having their loss ratios and their loss expenses now properly accounted for, so they're accurately pricing the risk, so that it more resembles a more incumbent type auto insurer in terms of the loss experiences. But if you can't acquire customers at a reasonable price, it doesn't matter, because you will always be losing money. The average auto customer is shopping probably every year or two nowadays, and the life of a customer is less than 5 years, typical auto customer. So at an $1,800 cost per acquisition, you've lost money on that customer.
Do you remember from the top of your head what's the average customer cost of acquisition for car insurance?
So you probably need to be somewhere between $100 to $300, depending upon what your model is, to sort of be able to be profitable based on the acquisition costs.
Mm-hmm. Interesting, because one of the challenges that we see for most of the insurance companies, sort of car insurance, especially the ones that bundle and provide more than one product, is the ability to, let's call it, car insurance would be the getaway policy or gateway. Yeah, that will be the right description, sort of drugs as the gateway to something else. And from there, you'll always try to cross-sell them home, commercial, etc., etc. So they will buy that 1.5 years or 2 years of cost. And that more or less can segue us to the question, they introduce rent insurance. Where do they stand with their cross-sell for rental insurance? How many they manage to convert? And is that something that will actually play more results and later on affect their share price?
I don't have the exact percentage, but in terms of renters policies, it's less than a percent of their car policies. Mm-hmm. So while they are cross-selling, it's not at a huge rate. It's not a huge number. And in the end, they're just acting as a broker there because they get a commission from HomeSite, which is who they have the relationship with.
So basically, I think that they sold about 9,000 policies. So if the
to use your previous comment for the numbers geeks, 8,835.
Perfect. And if it's only commission, let's assume they get 15% commission from what is it? Rent? So that will be less than $1,000 a year.
For sure. Renters would be maybe $100 to $200 a policy, right? So it's not a huge contribution to their bottom line. But by the same token, they are showing, as others, that there's increased stickiness. So the retention rate for those kind of customers is a little bit better. And that's the same reason why you see now Lemonade moving into auto insurance.
And because I was just about to say that, which of course Lemonade pops to mind. So yeah, sorry, I cut you in the middle. Lemonade.
No, so at the end of the day, almost every carrier who offers multi-line policies sees that having an auto policy and a home policy, or an auto and a renter's, or an auto and something else, or a renter's and a pet, sees greater retention. And retention is where true profitability occurs, right? It's because you no longer have marketing costs associated with that policy, and it becomes, you shorten the time to profitability. And if you for another episode when we might talk about Metro Mile or about Hippo, they went into partnership for that same reason, right? To increase the stickiness between the for a policyholder.
So I assume that the majority of the listeners of my channel and content are usually insurance people, so they understand loss ratio. But if by mistake someone who is looking for, investments and information about it, to be precise, information about the investments for entertainment only, their numbers in terms of operation, mainly on the loss ratio, improved. They are at 77. How does it? Can you explain a little bit more about how it's improving and what does it mean for the bottom line?
Yeah, so I think at the end of the day, the bottom line of loss ratio, if you remember sort of what's a combined ratio, it's the level of profitability for a company, and it's revenue divided by expenses, and the loss ratio is the loss ratio and loss expenses, i.e., adjusting, paying for everything, all the staff, all that kind of stuff. That's themselves has dropped into the 60 or 70% range. But if you think about your general administrative expenses, might be 20 to 30%. And if your loss is 30%, if your loss is 60 or 70%, you're already over 100%, just, adding those together. And I think that's the challenge. And that's why getting it correct is important. And getting it correct is better understanding the risk you are underwriting. They talk about their decision management, their decision sciences, the fact that they keep iterating their pricing model. They do talk about decision management for marketing. For those people who know me, that's the world I came out of. And I would argue that they're probably not doing as good of a job as they should be, given their cost of acquisition, because that's where having that science is supposed to drive down the costs. But they are pricing better. And I think a very interesting piece around their customer acquisition that should lower their costs and perhaps improve their underwriting performance is this new partnership with GM, where a person no longer has to load up that application, drive with them for 3 months, and then they'll tell you how much they're going to charge you. They're using all of the data GM already had from your car to already put you in that right pricing category. And then so you have that transparency immediately. And in a lot of cases, having the data directly from the actual vehicle is far more important for a carrier. Also in terms of an accident, because the car itself is smart enough to now know that it's damaged, that it was in an accident, and God forbid you can't communicate because you were seriously injured, right? That's one of the best things here, is that the car can, through OnStar, call for medical care, right? And all of those things, I think, will do wonders for their customer experience, which already is very good compared to most auto carriers. Yeah,
I think that in terms of their telemetrics and data science, they are one of the top 3. Robert Smithson was on my podcast. He's a founder and CEO of Just, and he gave credit to two other competitor of his, Justice, another car insurance carrier, and that was, of course, Root and Motion Auto. And Motion Auto are an MGA, Root, as we know, is a carrier. Cool, great. So what do we need?
So by the way, just one other, taking us in a complete circle, which isn't, a little bit off on a tangent. Just recently, Cambridge Telematics, which is one of the telematics providers, which many carriers use to help price people's driving behaviors, just bought TrueMotion. And TrueMotion is another one of those carriers that has actually had very deep partnerships, for instance, with T-Mobile and T-Mobile Sync, which was a TrueMotion thing. So all of this confluence is actually going to change the dynamics. And more importantly, I think you're starting to see that more and more traditional carriers are starting to explore using telematics for pricing. And as they start to do that, the unique advantage that a Root might have is going to erode. It's going to become very much more of a commodity.
So I was about to ask more about marketing and the latest NASCAR sponsorship and stuff like that, but we can put that on hold and talk about the competition. So incumbents, other carriers, new MGAs, Clear Cover, etc. How do they compete? And what do they need to do in order to close the gap? Or how can Root keep their advantage?
Look, in the end, tying a little bit into marketing, right? Brand recognition does matter, right? And there's no question about it. And so if you, if you believe that the audience that is attracted to NASCAR is a good audience to underwrite, then having that partnership is a brilliant thing. And hopefully you're tracking it and able to monetize it and determine, right? Too often, for instance, corporate sponsors of a golf tournament, there is no ROI. It's just it was a decision by an executive that says, I'm into golf, we're doing this sponsorship, and I don't care, right? But in the case of Root, that their cash balances every quarter are going down as they're burning through cash because they're losing excess money, right? You've got to make sure that all of your marketing spend is effective and efficient. And, how is it that they're going to continue to win? It's making sure that they have a good customer experience. It's making sure that they're pricing the risk appropriately and acquiring the customers at a cost that their actuarial models can bear. And it, like any of these startups nowadays, it not only is it the direct piece of going direct, but they have to build additional distribution relationships, and then that's the key. So GM might be one of those examples, but the distribution relationships really do help drive down acquisition costs.
So is their product fits agents?
Right. So it's the way an agent would sell their product is the way they sell any other product, which is for the most part, a combination of price and value. So if the price is right and the agent perceives that there's value en route, then they'll recommend that to an agent, to their policyholder or to their customer, and the customer will choose it, right? Going direct, it's a very different story. And so as long as they are priced appropriately, they can certainly win in the independent agent channel if they're on the right platforms, if they're integrated with the agency, quoting systems and the likes, right? And so to that extent, that too will help drive down costs. But by the same token, with the agent, you're giving up that much more of your premium. And don't forget that Root did set up its own agency, partially to do the cross-sell piece, and then also to maintain the commissions in the corporate family as they write policies themselves.
Let me take you quickly to the share price and the opportunity there. So today, as we said, it's 10.71. If we are going back to that 27 that it was on the day of the IPO, that's almost 200, actually 190% opportunity only to go back there. How do we actually, is the share price make sense in terms of what we have seen? And 5 years in the future,
So
what needs to happen in order to reach the, I don't know, an 8 multiplier?
yeah, Gilad, if I had, my little magic ball or my little genie, I'd be rubbing.
Oh, you don't have one?
No,
let me check
no.
where's
I
my,
would definitely be leveraging its intelligence. But look, at $10, if they're continuing to lose money, they're overpriced. At $10, with the trajectory that they're showing in terms of reining in expenses, reining in the loss ratio, then it would seem that they have a ways to go up. Will they be able to hit 27 quickly? I don't know. If they have the sort of magic spice that a lemonade has, for sure, right? But by the same token, lemonade is probably on the opposite end, right? Overvalued given their results and their data, their results and their size and their premiums written. So it's very difficult to sort of figure out and pinpoint. They do a lot of right things. They're certainly advancing and at the higher end of understanding driving behavior. But as I said, there are many competitors now in that, and many competitors in the telematics. And at the end of the day, if by using telematics you truly do understand a person's behavior, you run the risk of one of two things. You have adverse selection and get the worst risk, or at the end of the day, you price the worst risk too high, and what you're left with, which is good risk, you don't have a big enough body of policies to spread that risk across. And consequently, when there are larger claims, which include bodily injury, at the end of the day, your results will suffer because of that.
Now, I think that we already spoke enough time that we are going to lose the concentration and the attention of our audience.
Forget ours. How about your and my attention?
Oh, listen, I've been keep drinking my coffee here, so I can stay focused and energetic as well. Maybe in our future we'll talk about Lemonade and breakdown, because as I think about, reading their Q1 report and the breakdown between, the operation and what it means, and to read how the insurance itself, the KPIs that we have for insurance affect their operation. I just thought about that recently. They had a new reinsurance agreement and how that affects their profitability, because they had a little bit of a sin there.
Yeah.
Do you have any insights about that? How much they're actually gaining now, or how much money they are keeping?
Well, look, their reinsurance agreement, as they've stated, is pretty simple. It's 75-25 and the same on the risk. So to the extent that they're actively and accurately pricing the risk, then they're doing pretty well. To the extent that they miscalculated the risk, then they're going to own a bigger piece of it, and they didn't plan for that. So, but all of these startups, and this is probably a conversation for another episode for us to do. At the end of the day, whether they are already IPOing, whether they're choosing to go through a SPAC, or whether they're just raising money, at the end of the day, they are being valued very differently than an insurance company by people who traditionally invest in insurance businesses. And that difference is what explains the difference in their stock price, the difference in the capital markets and what they're willing to provide for these companies. And that's an intangible. And as long as that's going to continue, and as long as treasury bills are still at or essentially around zero, all of this excess capital in the market needs to go somewhere. And these kind of companies are among the better bets right now.
So what would be, and that will be like the final question for today, what is the main differentiator between investing in an existing insurance company versus one of the new IPO'd SPAC entrants?
I would say are you a conservative investor or are you a gambler, right? Or are you a technology investor or are you a contrarian, right? So if you're a conservative investor, then you go for a traditional carrier because for the most part, they understand the business, they've been pricing it fairly accurately, and you know what you're getting. But if you want better returns, quicker returns, the better chance to do what I heard today, some guy who bought a version of a cryptocurrency for $20 and was a trillionaire overnight, right? If you want something like that, he's not going to keep the trillion, but that's a different story as I see your face. But if you want something like that, then you're investing in these startups. No questions asked. But if you are a seasoned investor who's investing for the long haul, who is looking at fundamentals, then you're probably investing in traditional carriers.
Kaenan, thank you very much for today.
Gilad, I loved it. It's fun talking to you. Look forward to doing more of these.